Right now, there are at least 5 legal documents that the typical American homeowner, age 65 and above, is completely unaware of. Documents that can halt, reduce, or permanently cap the property tax they hand over every single year. 5 documents. And before I go any further, I need to address something important because this is the biggest misconception surrounding property tax exemptions. And it is the very reason most seniors who are fully eligible never submit a single application. People think a video like this only applies to one type of homeowner. Some believe it is only meant for low-income retirees who are financially struggling. So if they own a comfortable, fully paid-off home, they stop listening. Others assume it is only relevant to very wealthy individuals with large estates. So if they are living primarily on Social Security, they check out. Both assumptions are completely wrong, and it does not end there. Some of you are thinking, my home is already paid off, so the property tax is not really a burden. It is. It is the single largest recurring expense you will ever face on a home you already fully own. The county does not care that your mortgage is finished. They still send that bill, and some of you are currently renting and assuming this has nothing to do with you. It does, because your landlord is paying that property tax and passing every dollar of it directly to you through your monthly rent. When that bill decreases, your rent stops rising the way it has been climbing. So this list is relevant to every single one of you. Whether your home is valued at $90,000 in a small rural town or $400,000 in a county that just completed a reassessment, there is real money sitting on this list with your name attached to it. For certain documents on this list, the greatest benefit goes to lower income retirees. For others, the biggest advantage belongs to the homeowner sitting on a fully paid off property that has tripled in value. I will explain on every single one exactly which group benefits the most, so nobody watching can honestly say, this does not apply to me. Because the plain truth is that homeowners at every income level are quietly overpaying their property tax bills, just in different ways and for different reasons. The reason almost nobody ever tells you about these documents is painfully straightforward. Your county tax assessor's office is funded by the very taxes that office collects. Every dollar handed out through an exemption is a dollar that office does not have available to spend the following year, so the county is not going to call you and announce that they can freeze your taxes. The county is not going to mail you a senior exemption application on your 65th birthday. Your mortgage servicer is not going to highlight it on your account statement. The real estate agent who sold you the property never brought it up, and the average annual property tax bill in this country sits at roughly $4,800. For a 65-year-old who continues living in their home for another 2 decades, that adds up to nearly $100,000 walking out the door on a bill that, for many of you, should be a fraction of what you are currently paying, or in certain situations, absolutely nothing. Over the next 20 minutes, I'm going to walk you through all 5 documents, one at a time, in plain and simple language. After that, I will cover 3 bonus strategies at the end for homeowners who have accumulated some real assets, because those final 3 can be worth an enormous amount of money, and almost no one ever discusses them. Here is the single idea that connects everything together. Being legally exempt from a property tax bill and actually not paying that bill are 2 entirely different things. The law does not issue refunds automatically. Nobody at the county mails you a check without prompting. You have to be aware that the document exists and you have to go ahead and file it. That is the entire purpose of this video. My name is Walter Barron. I'm a licensed estate attorney admitted to the State Bar, and for more than 15 years, I have sat across the table from county assessors, probate clerks, and IRS revenue agents on behalf of actual homeowners. And I will tell you the single most painful pattern I witness year after year. It is not people attempting to exploit the system. It is honest, responsible homeowners in their 60s, 70s, and 80s paying property tax bills they were never legally required to pay, year after year, simply because no one ever told them which document to file. That is the most costly kind of mistake there is, because it is completely invisible. There is no warning notice, there is no financial penalty. There is just money quietly leaving your account every single year that never needed to leave in the first place. So let us correct that right now. 5 documents plus 3 bonus strategies. Stay through to the end, because the very last form is the one that silently drains the most money from people's accounts. And it also happens to be one of the simplest to claim. Let us begin with the one almost every homeowner should already have in place. Document number 1 is the Homestead Exemption. And I need you to truly take this in, because this is the document most homeowners assume is already filed on their behalf when it is not. Every state in the country, with only a small number of exceptions, provides some version of a homestead exemption on your primary residence. What it does is remove a portion of your home's assessed value from the equation before the county calculates your tax bill. In Florida, that portion is $50,000. In Texas, it is $100,000 applied to the school portion of your bill. In Illinois, it is $6,000. In Georgia, it is $2,000. Every state is different, but every state offers something real. Here is where people get tripped up. In certain states, the homestead exemption is automatically applied when you purchase the home. In the majority of states, however, it is not. You are required to submit a one-page form to the county appraisal office. Typically, before April 30th of the year, you want it applied. Miss that deadline and you pay the full bill for that entire year. File the form once, and in many states it remains on record for as long as you own the property. One piece of paper, submitted one time. Hundreds, sometimes thousands, of dollars removed from your bill every year going forward. Now let us talk about who this helps, and the answer is everyone. If you are a lower income homeowner, that $50,000 exemption in Florida or that $100,000 exemption in Texas can reduce your bill by a third or more. And if you are a comfortable retiree sitting on a fully paid off home that doubled in value during the pandemic, the homestead exemption is also the gateway to nearly every other exemption covered in this video. The county will not allow you to claim the senior exemption, the freeze, the deferral, or the circuit breaker unless your homestead exemption is already on file. So if you only take one action after watching this video, call your county appraisal office tomorrow and ask one simple question. Is the homestead exemption currently on file for my property under my name? If the answer is no, ask them which form you need to submit to get it added. That is document number 1, and for many of you, it is the key that unlocks everything else. That was the foundation. The next 4 carry even more weight. Document number 2 is the senior or age 65 exemption, and this one sits directly on top of the homestead. Most states that provide a homestead exemption also offer an additional exemption that activates the year you turn 65. And this is the form the county will almost never proactively send you. It is a completely separate document. You have to specifically request it by name. The benefit amount varies considerably. And this is where the lower income advantage and the middle class advantage begin to diverge. In Texas, every homeowner aged 65 or older receives an additional $10,000 reduction on the school portion of their assessed value, stacked on top of the $100,000 homestead exemption. In Florida, the senior exemption can add another $50,000 on top of the standard $50,000 homestead, effectively doubling the total reduction. In New York, the senior exemption can slash the assessed value by up to 50% for qualifying seniors. In Illinois, an additional $8,000 reduction applies, and every single one of these requires a separate application from the basic homestead form. Now here is the part where financially comfortable retirees tend to stop paying attention, and that is a mistake you cannot afford to make. Many states place an income limit on their senior exemptions. New York's, for example, sits at around $58,000. Illinois is around $65,000. If your income exceeds that threshold, you probably assume you do not qualify, so you never apply. But more than half of the states with a senior exemption do not include any income test whatsoever. Texas, Florida, Georgia, Tennessee, Mississippi, Alabama, and several others operate entirely on an age-based qualification. Income is irrelevant. Home value is irrelevant. You turn 65, you file the form, and you receive the exemption. So if you are 65 or older and living in your own home anywhere in this country, your single task after watching this video is to contact your county assessor and ask, what is the senior exemption application in this county? What are the eligibility requirements, and when is the filing deadline? Get the form, file it once, and stop overpaying. Now we arrive at the one that truly moves the needle. Document number 3 is the senior assessment freeze, and this is unquestionably the most valuable form on this entire list. Here is exactly what it does. When you reach age 65 and file the freeze application, the county locks your home's assessed value at whatever it was in the year you applied. From that point forward, regardless of how much your neighbourhood gentrifies, regardless of how much your home appreciates, regardless of how aggressively property values rise across your entire zip code, your property tax bill is calculated based on the frozen value, not the current market value. Your home can double in worth. Your tax bill stays exactly where it is. Let me walk you through the clearest possible example. In Texas, once you turn 65 and submit the over 65 tax ceiling application, your school district property tax is frozen at the exact dollar amount you paid the year you turned 65. Not the assessed value, but the actual bill amount itself. Your home's value can triple. That bill cannot increase. In Illinois, the senior assessment freeze locks in your equalized assessed value for as long as your household income remains below a state-defined limit. In New Jersey, the senior freeze program reimburses you for every dollar of property tax increase above the amount you paid in the year you first qualified. Different mechanics across different states, but the same fundamental outcome. Your tax stops growing, and this is where financially comfortable middle-class retirees suffer the greatest damage from not knowing this form exists, because the freeze delivers its most powerful benefit in precisely the type of neighbourhood where a comfortable retiree is likely to live. If your home was worth $220,000 when you turned 65 and is now valued at $440,000, and you never filed the freeze, you are currently paying taxes on every single dollar of that appreciation and will continue doing so for the remainder of your time in that home. The homeowner directly across the street who filed that form is paying taxes based on the $220,000 figure. Same house, same neighbourhood, same year it was built, two completely different tax bills. The only distinction between them is that one person filed a single form. There is one critical rule about the freeze you need to understand. In most states, you are required to file within a specific window, typically between January 1st and April 30th of the year you turn 65, or in some states the year following. Miss that window, and in certain states, you lose the freeze option permanently. That is why this form is the one I advocate for most loudly. Contact the county immediately. Ask for the senior tax ceiling or senior assessment freeze application specifically by name. Even if you turned 65 3 years ago, many states still allow you to file. The exemption applies going forward, not backward. So every year you delay is another year of overpayment you will never recover. That is the form most homeowners never hear about. The next one is even less discussed. Document number 4 is the circuit breaker, and this one is aimed specifically at homeowners living on modest or fixed incomes. The name originates from the concept that when your property tax bill climbs past a certain percentage of your income, a breaker, similar to an electrical circuit breaker, activates and the state refunds you the excess amount. Most people have never encountered this term in their lives, yet nearly every state offers some version of it. Here is how it functions in straightforward terms. You submit an application to the state, typically as part of your annual state income tax return, even if you do not actually owe any state income tax. You report your total household income. You report the property tax you paid during that year. If your tax bill exceeds a designated percentage of your income, somewhere between 3 and 6% depending on which state you live in, the state either sends you a check or applies a credit to your state tax account for the difference. Massachusetts, Maine, Vermont, New York, Michigan, Minnesota, Missouri, Maryland, Wisconsin, and Illinois all have circuit breaker programs for seniors. The benefit amounts range from a few $100s annually to more than $1,300 per year. And critically, the application is a state-level form, not a county form, which is a significant part of why almost nobody is aware it exists. The county will never mention it, because the refund does not come from the county. If the majority of your income comes from Social Security and a modest pension, and your property tax bill is consuming any meaningful portion of your monthly budget, you almost certainly qualify. The income thresholds in most states are not particularly restrictive. New York's basic credit threshold is just under $29,000, and the enhanced credit kicks in at a considerably higher level. Maryland's ceiling is closer to $60,000. This is not a program designed for people in poverty. This is a program built for working middle-income retirees, and the application is typically a single page found near the back of the state income tax instruction booklet. So if your state appears on that list and your household income falls below roughly $60,000, search online for the phrase Circuit Breaker Property Tax Credit, followed by your state's name, and file the form. Some states will issue refunds for prior years. Others only apply the benefit going forward. Either way, the form costs nothing to file. The application is one page, and the resulting check is very real. And now we arrive at document number 5, the one I promised at the beginning. Document number 5 is the property tax deferral. This is the form almost nobody discusses because every county and state that provides it treats the information like a closely guarded secret. Here is what it does. If you are a homeowner above a certain age, usually 62 or 65 depending on the state, and you have lived in your home long enough to satisfy the residency requirement, you can submit an application to defer your property tax payments entirely. That means you stop paying property tax. Not a reduced amount, but a complete stop. The state covers the property tax on your behalf, and the unpaid balance becomes a lien against your home, repaid only when you sell the property, refinance, or when the home is transferred to your heirs. For a homeowner who is asset-rich and cash-poor, which describes the exact situation facing millions of seniors across this country, this program is genuinely life-changing. You can remain in the home where you raised your family for the rest of your life without writing a single check to the county. Oregon, California, Washington, Colorado, Texas, Tennessee, Idaho, Illinois, Massachusetts, and several additional states all offer some form of property tax deferral specifically for senior homeowners. And here is where financially comfortable, middle-class retirees should pay particularly close attention, because this program is not exclusively for low-income homeowners. In several states, the deferral is available without regard to income level at all. The interest rate the state charges on the deferred balance is modest, in many cases between 2 and 6% simple interest, and the lien ranks behind your mortgage in terms of priority. If the alternative you are facing is selling a home you deeply do not want to leave simply to keep pace with rising tax bills, this form is your answer. There is one important rule you must be aware of when you are out in Augie. If you currently carry a mortgage on your home, you need to verify with your lender first, because certain mortgage agreements classify unpaid property taxes as a default trigger. For a fully paid-off home, the deferral process is clean and uncomplicated. One application filed at the County Treasurer's Office or State Revenue Department. Annual renewal required. Tax bill disappears. That is document number 5. And it is the one that silently costs people the greatest amount of money to skip. Because every year you continue paying a tax you are legally entitled to defer is a year you withdrew money from your retirement savings to hand over to the county. For some of you, that single form alone will be worth more than the other 4 documents combined. If you have any accumulated assets at all, the next 3 minutes are going to save you more than the past 20. 3 bonus strategies. The first applies to any homeowner who has served in the military. The disabled veteran exemption exists in nearly every state, and depending on your service-connected disability rating, it has the potential to eliminate your property tax bill entirely. A 100% service-connected rating in Texas, Florida, Virginia, Pennsylvania, and numerous other states translates to 0 property tax for life on your primary residence. Even a partial rating, 30%, 50%, or 70%, frequently results in a proportional exemption that stacks on top of every other exemption covered in this video. The application is typically a single page plus a copy of your VA disability determination letter. If you served, file this form. If a parent or spouse served, investigate whether the exemption can be transferred to surviving family members. The second bonus strategy involves the surviving spouse carryover. When a senior homeowner passes away, their senior exemption, their assessment freeze, and in many states their disabled veteran exemption do not automatically transfer to the surviving spouse. They must be reapplied for, typically within 1 year of the death. And the surviving spouse generally needs to be at least 55 years of age, though some states allow a somewhat younger qualifying age when dependent children are present. If a spouse passes away and the surviving partner does not file, the property tax bill can increase dramatically overnight, sometimes by thousands of dollars, on the very household that just lost half of its income. Most counties will quietly allow this to happen and never raise the subject. The application form is brief, The filing deadline is firm and real. Do not allow the county to quietly pocket your spouse's exemption. The third bonus strategy is the one that has nothing whatsoever to do with the county offering you a discount. This one involves you formally contesting your own assessment. Every property tax bill is constructed on top of the county's appraised value of your home, and that value is assigned by an assessor who has quite possibly never set foot inside your house. They rely on neighbourhood comparable sales. They use square footage measurements. They make broad assumptions, and they are wrong with remarkable frequency. Every county in this country maintains a formal protest process, typically available within 30 to 60 days following the appraisal notice. You submit a one-page protest form. You bring 3 comparable sales from your immediate neighbourhood that sold for less than your appraised value. You appear before an appraisal review board for roughly 15 minutes, and in a significant percentage of cases, your appraised value is reduced, sometimes by tens of thousands of dollars, which translates directly into hundreds or thousands of dollars removed from your tax bill for that year and every year going forward. Filing a protest costs absolutely nothing. It does not require an attorney. The county will not advertise that this option exists, and in most counties, fewer than 5% of homeowners ever file a protest, even though something close to half of all protests that are filed result in some form of reduction. Protest your assessment every single year, especially in the year you turn 65. None of what has been covered in this video happens automatically. Your county will never pick up the phone to call you. Your mortgage company will never flag it on your statement. Your tax preparer will never raise the subject. Every single form on this list, every last one, is sitting on a shelf at the county assessor's office, waiting for you to walk in and ask for it specifically by name. The seniors who successfully claim these exemptions are not luckier than you. They are not wealthier than you. They simply knew that the form existed. If you would like a single-page checklist covering every document discussed here, plus state-by-state filing deadlines, and a phone script you can use when calling your county assessor's office, I have made a free copy available at walterbarronlaw.kit.com/property-tax-checklist. The link is in the description below. If you know even one homeowner over the age of 65 who is still paying a full property tax bill, please share this video with them. That one share could save them $4,800 in the coming year, and unlock a freeze they never knew was waiting on a form they never knew existed. Thank you so much for watching.